Welcome to TheoTrade. This is Don Kaufman. It's December 8th, 2018, and you are watching the TheoTrade Weekend Update. Volatility becoming the norm inside of this market, but before we get into this video, we really want to just give you a stern warning right across the bow over here, and that's this. Okay, you gotta tune in to some of the points that I am going to make right here, right now, because there is an extraordinary amount of risk in this marketplace, both to the upside and the downside, of course, depending upon whether you're long, whether you're short. However, there's also a very dramatic risk to premium sellers. Let me make a couple points. We're going to get into some detail on the charts over here in just a moment, but let's get down to it. First thing we want to talk about is this volatility box. Now, for those of you that have never really heard that term, I've actually termed it a volatility box. So in kind of early October, the S&Ps dropped into what I term a volatility box. And that volatility box is from roughly 2,600 up to about 2,800, right? So it's a 200-point volatility box. I've actually dubbed it the Hurt Locker here at TheoTrade because people are just getting ripped apart in this 200-point volatility box. Right now, we're towards the lower end of that volatility box. Again, we're sitting, just north, again, of that 2,600 level. We look like we're going to blow through it. And that's where everybody's like, well, Don is bearish. You would expect me to be really bearish. That's not my concern right now. I'm telling you, right now, I refuse to allocate any more capital until I actually see exposure, okay, of what it's really going to be on the other side of this volatility box. I'm going to tell you why right now. Okay, so again, you have this range from 2,600 to 2,800, and we're kind of trapped inside that range. We're right towards the lower end. Now, the financials have already broken through the bottom of the vol box, okay? You also have the Russell that's actually cracked into lows. If you want to look at individual equities, you can, but Apple is actually at year lows. In fact, Apple is now down on the year, but neither here nor there. Okay, we're right at the bottom of the volatility box, and again, what's wrong with that? Like, are we going to break lower? I'm going to tell you exactly what's wrong with it. The volatility is what's wrong with it right now. That is, and I'll give you a couple of for instance here. If you're just trying to get purely long this market or short this market, fine. But I think you have to recognize, okay, with some of the wild moves, any allocation that you make at the bottom of this volatility box, okay, may just be hideous and the wrong one. You get short right now, you're going to get your head popped off your shoulders. Do you realize that the Dow, okay, in 4 trading days this week, because again, the week was shortened, but in 4 trading days, the Dow had an 1,800-point range, okay? You should feel the fear, right? The other thing that happened this week, we actually had a velocity logic event. Now, I can guarantee that 9 out of 10 people listening to this have like, that sounds really exciting. I have no idea what it means. That's when the Chicago Mercantile Exchange, their algorithms turned on and actually slowed and halted trading. It was on Wednesday, okay? It was on Wednesday when the futures reopened. It was not during cash markets, but there was a velocity event. And that effectively means like, there's algorithms slowing down the entire marketplace. They're like, no, the S&P's moved. The S&P futures moved 75 points in a 3-minute period, which triggered a velocity event. So whether you're long, whether you're short right now, okay, listen, I'm going to be short this marketplace, but I'm short out into the future. The positions, though, that I continue to add, I'm being, again, extraordinarily careful. I'm totally like hands off right now because, again, I want to see what happens when we break below this volatility box. And again, to get into the specifics, it just comes down to this, all right? In the last couple of weeks, we've had these expected moves in the SPX. Okay, effectively, this coming week, there's about an $82 expected move in the coming week. $82. Well, it's substantially higher than we've seen in any previous weeks. But the bottom line with this, I looked back at just the most recent 10 weeks inside of the SPX. Okay? Now, you're supposed to stay inside of the expected move about 68% of the time. But we've actually found over the last 3 years, we've stayed inside the expected range, okay, in the upper 80%. So, again, we're supposed to stay inside of, let's say, an 82-point range. And 68% of the time we're supposed to do that. But we're not staying in there 68% of the time. We're staying there over 80% of the time. However, in the last 10 weeks, 5 out of the 10, we've actually cracked through the expected move by the end of the week, stayed outside the expected move. I'll show you that here again in the charts in just a moment. So what do you got? You got a 50-50 chance of staying inside the expected move. However, the VIX, does nothing. The VIX, where is it? 23. What has it done for me lately? Absolutely nothing. Okay, you put this together with this volatility box, which again I call the hurt locker. The VIX is really low. It is a nightmare right now. It is a nightmare if you're trying to sell option premium. You sell option premium, the market right now is saying, come on, little closer, bring out your allocation, come on, amplify contract size, and then is probably going to pounce on you like an 800-pound silverback gorilla. Think about that for a second. There is huge risk right now in selling premium, and that's why I'm saying in terms of allocation, I can get a little bullish, a little bearish, but I want to see us break through the volatility box because it is going to be a premium sellers. First of all, the people that have sold premium right now, it's going to be your nightmare. For me, it's going to be a party because I think what's going to happen here is the moment we crack through the volatility box, the vol will actually explode at that point. All right, so this tight range, which I call again this volatility box, the hurt locker, we break outside the bottom of it, okay? All of a sudden, the VIX takes off to the upside. Premium sellers are getting hammered. That's when we're going to step in and start to allocate. And I cannot stress this enough. This is not a marketplace. This ain't a time for heroes, right? It's not a time for heroes to be made. We're 300 points off the high. Okay, it's less than 300 points off the high in the S&Ps. We've come down just a little bit. Okay, we're going to talk about again a lot of very definitive areas that you need to be concerned about right now. Hold back your allocations until you've seen Act 1 of volatility. Wait for Act 2 to kick off before you start to allocate. With that, let's get to some of the charts.
All right, let's get down to it. Let's start with the SPX. I made a couple of bold statements on the video portion. I want to take you into some very, very needed detail. All right, let's get down to it. Let's start with the SPX. I made some fairly bold statements on the video portion of this. Well, let's take you into detail as to why I'm saying hold everything until you fully understand the risks you're about to embark upon. As I said, this is the SPX. These hash marks are indicative, of course, of the expected moves on a week-to-week basis. Now, I mentioned that in the last 10 weeks, and again, I'm just boxing kind of in the last 10 weeks over here, so everybody's kind of familiar with where we're starting. We're starting right again in early October. You've got 1, 2, 3, 4, 5 breaches. Again, 5 breaches of expected move. Each one of those breaches, of course, is highlighted on my chart. Now, 5 breaches in the most recent 10 weeks coming into, again, what I term the volatility box, which I'll elaborate upon in just a minute. But one of the first bold statements I made is, premium sellers. If you're out there and you're selling option premium right now and you're heavily allocated, you're going to feel the fear. Okay, this is not a good situation because the market, by breaking through these expected moves, is telling you something. It's telling you it's doing a terrible job of pricing options. I'm going to further kind of delineate just that. Is the marketplace really doing a crappy job of pricing options? Yeah, maybe. So take a look at the VIX. Now, let's all kind of clarify and kind of quantify what is the VIX, right? So the VIX right now is, well, you're like, it's 23. Yeah, but the VIX is implied volatility, okay, 30 days out. So it's 30 days, it's out here, right? When I say out here, like here we are now, it's out here on the chart. That's the VIX. But if you compare that to what we call historical volatility or realized volatility, this is actual price movement in the marketplace. Well, if you kind of compare the two, I think it's a little bit alarming, if you will. Let me bring this up to your attention just a little bit more, and you'll see that historical volatility, this is just average over 10 days, is at 27%. So we're like a little bit of a catch-22 if you don't necessarily understand the volatilities. 27%. That means actual market movement is moving at a rate of 27%, but they're only paying you 30 days out for 23% movement. Does that seem like a good thing? If you're selling premium right now, you're getting ripped apart at a rate of 27%, but they're only paying you for 23%. Oh, that does not sound good. Now, on top of it, to compound the risk of a premium seller right now, to compound the risk of that, we could look at something called skew. Now, skew is total and complete like Geeksville. Like I don't want people to get all like caught up in skew. Somewhere in here, I have a style built here. There you go, skew line. Just so you know, the skew right now, it's pretty much the lowest that it's been. All right. I mean, here, there's something all the way back in 2014 where it's a little bit lower. Okay, but effectively, what I'm telling you, the skew is the lowest it's been. What the skew effectively means, okay, is that in the SPX, the out of the money puts in the SPX, okay, haven't really been this low. It means the implied volatility skew itself, okay, is rather flat. They're not paying you a lot to sell out of the money puts is what I'm telling you. Now, okay, what does that kind of amount to? So, all right, Don, you got it. Like volatility seems a little low. The skew kind of is lackluster over there. Well, now let's actually talk a little bit about this volatility box. And I'm going to bring up the spiders to do this. Why? I just think it's an easier way. So let's actually box this in over here. All right. You're looking at a 9-month chart. If you want, let's get crazy. Let's just open it up for like a full year. Here's some of the volatility. Now, the first thing I mentioned is, listen, we're only a stone's throw off still the all-time high. I think that needs to be thrown into perspective, because if you're missing that point, like, okay, all-time high now, all-time high now. And yet people are like, well, I'm ready to start bottom fishing. You're not going to be a hero in this. Who cares if we rally back up? When I say you're ready to start bottom fishing, okay, that means people are going to go out and they're going to buy stocks. We're right here. I mean, is that prudent right now? We're right at the bottom of the volatility box. Hey, if we start to rally back up, okay, maybe then you grab a stock. But I wouldn't make that move right now. I'm, Apple looks like such a deal at 168. Really? Okay. Listen, Facebook, they even announced they're going to do more stock buybacks on Friday. We'll come to that here in just a moment. But in this, this volatility box, let's actually box it out. That's why I call it the volatility box. Okay. This is why I call it the hurt locker. We drop into it. Okay. It has been Mr. Toad's wild ride. It couldn't be any more clean than this. And now we think we're actually ready to crack it. Now, we don't have any definitive evidence, neither do you. Nobody has any evidence. Who cares at this point? So what? If we go back up here, it's going to provide us some more opportunities. But if we crack through it, that's when the opportunities are going to fly. That's why I said hold your allocation at this point in time, which again is a really bold statement. Like I don't want to see people, okay, get ground through like, you're going to be a meat grinder in here. I've seen this movie before. I spent 15 years in the brokerage industry watching order flow. And right now, volatility is poised, okay, low. If it's going to break this low, it's going to explode, right? So the volatility is ready to explode in your face. People are going to sell premium, or if they're long stock, you need to be a little bit of afraid right now. On the flip side, can you short right now? No, you can't get short here, because the reality is you could have a rip your face off rally and be 200 points higher. I guess if anything, okay, you got to be extraordinarily careful on both sides. Let the move happen, okay? Let Act 2 kind of kick off before you really step out and start to take some of that risk. Again, in this volatility box, what is appropriate to discuss is that a product like the XLF, the financials have already cracked through it. So the financials, they're on the outside, not by much, but they're definitely on the outside. We could also, okay, make that point here in the Russell, where the Russell has had, again, the Russell led us down in October. It was actually on the forefront of the sell side activity. Can we assume that that's going to be the case this time? Oh, I don't think that's necessarily a fair assumption. Okay. Other big, stocks. I was mentioning Apple over here. So Apple, okay, is the most important point. It's down on the year. So it's, for the most part, it's in the most trouble that it has been at any point this year. Now, granted, there's a lower price point earlier in February, okay? But you have to realize, all right, year in large, Apple is actually down on the year, and that is very, very telling, okay? Now, That doesn't necessarily mean that we're going to break out of the volatility box. Nevertheless, it's incredibly important when your largest market cap, or should I say former largest market cap, is under duress and is now down on the year. Okay. Meanwhile, we have something like Microsoft still up 22%. Remember, okay, we just talked about a recent position where we got short Microsoft. Again, we got short Microsoft, and it's been playing out extraordinarily well. Other positions that we're actually in right now, and again, we're just leaving them alone. We talked about just last weekend, talked about getting short XLV. If you didn't like getting short XLV, okay, we talked about getting short United Healthcare. All of these positions, everything that you've thrown at the marketplace inside of the last 3 weeks is working out right now, literally. Okay, we've talked about McDonald's, we've talked about Starbucks. I can go on and on and on and on, all the different positions over here. That is not what's important right now. Again, I can't stress enough, all right, that we're ready to actually crack this volatility box, and that we're only, again, just a stone's throw off of the all-time highs. And that's where we see risk. I mean, let's talk about the broader market for a second. This is 3 years of the spiders, but I want to broaden that horizon a little bit further. I know this looks a little crazy, okay, but this has a lot to do with just risk reward. And let's actually kind of get to another point that I really want to make over here is everything you're listening to in the media right now, the Fed. Okay, time out. Stop talking about the Fed. Forget about the Fed. Look at the chart for a second. Let's first of all talk about risk reward. Why? Okay. You have to recognize, when I talk about people bottom fishing in this marketplace, you got to recognize what's your upside potential versus the downside risks. And you know what? There's no definitive answer to that. Okay. But when you start to look at this really wildly broad chart, I think it makes a lot of sense that the downside risks are not only apparent, but they could be really catastrophic to you in terms of, again, we're looking at the spiders, but it doesn't matter. It's the S&P, right? So think about, and again, you come up with your own answer for that. What's your upside potential versus the downside risks? Why am I saying that? Because it might make you think twice about trying to go out and be a hero again in this marketplace. Now, everybody's talking about the Fed. What's the Fed going to do in December? Take it off the table. It doesn't really make a difference at this point. Listen, it's not about the Fed, okay, hitting the markets by raising interest rates. It's about the Fed, okay, pulling, okay, the rug out from the balance sheet. Now, I've got a couple of slides I'm even going to show you here momentarily on this front. But the Fed is going to continue to contract the balance sheet. The continuation of contracting the balance sheet is going to pressure markets. All right, enough said. Okay, until the Fed starts to, reverse the whole idea of like, let's not contract quantitative easing, let's do quantitative easing. Like, listen, the Fed ain't got our back anymore. You just got to keep that in mind. So China, let's talk about China for a second. Forget about China. You're like, done. Okay, what, we want to talk about Huawei and the, the CFO that gets arrested. It's fine. Okay, but we already know it's going to play out. And whatever, there's nothing you could do about that. It's kind of like a little bit of a binary event, but it's kind of past, right? And the tensions are going to continue for the time being. So put it aside because, well, there's nothing you can do about it. Now, what are some of the bigger and broader aspects that I'm focusing on right now? Again, I don't want to start to create like, again, what do I think about that? That doesn't matter. Okay, what do you think about the Fed? Who cares? As I said, they're going to just keep the accelerator going in terms of contracting the balance sheet. What about China? Hey, for the time being, okay, we're going to be what? We're going to be in tariffs. Great. Okay. Maybe the relationship breaks down a little bit more, whatever. Can't really worry about that. I think the marketplace is already pricing in some of the risks over there. The area that I don't see the marketplace pricing in risks. Let's get down to it. This is actually volatility in the mix of record buybacks. So I wanted to take you to a slide really quick because the slide that you're looking at right now, kind of the fun irony, this is as of Q2 2018, and I intentionally took an older screenshot. Buybacks soar faster than capital spending. So cap spending versus buybacks. Take a look at 2018. Oh, okay. You're like, I don't really get this. Yeah, that's just buybacks. It's just a really, really large amount of buybacks. But I don't think this one necessarily does it justice. Okay. This next slide, this one's going to do it justice. Companies set to buy back $1 trillion worth of shares this year, and that should keep the market afloat, Goldman says. Okay. Thank you very much, Goldman. By the way, this was actually published on August 6, 2018. I just wanted to throw that out there because companies are not only expected to authorize more than $1 trillion in share buybacks, they are buying back in record amounts. Okay? And we're still in this bout of volatility. Wake up. Why? Because what people are not focusing on, okay, is literally what I call the writing on the wall. All right? Buybacks are going to taper because now CEOs, they're getting nervous. They're going to start to get nervous now in terms of what they're doing with the cash. They're going to start to get a little bit more cautious moving forward. The irony of that is that Facebook literally announced an additional $9 billion, $9 billion, okay, of stock buybacks right at the close on Friday. And look what happened to the stock. So the stock was down a couple of bucks. It shot up on the idea of buybacks. By the way, it shot up how far? This is really important. It shot up from basically, okay, 137 and change all the way to 139, and then they faded it again. Why did the marketplace start to fade it? Because buybacks are not going to be in vogue in the future. I want you to start to think about that. Buybacks are going to start to work against companies. Those buying back their stocks are going to be ostracized for doing it. They're going to make the buyback word a very, very naughty word. Okay? I can't stress enough. It's going to be time to get back to selling some options premium because now the volatility is very likely to just start to rip wide open in this marketplace. Again, there's a huge amount to think about in this weekend's video. The next, what I call Act 2, breaking out of this volatility box. It's going to be violent. It's going to be vicious. Okay. Again, we're less than what? 300 points removed. And that's 300, let's make it fair, S&P points removed from the all-time high inside of this marketplace. And people are already, okay, starting to feel the fear a little bit. You haven't really seen anything just yet. Sit back, wait for the market to come to you, okay? We're going to continue to allocate, but we got to see, okay, what is on the other side of this box. Thanks, everybody, for joining us on this weekend's update. Have a wonderful weekend. Bye-bye.